Hello, everyone, and welcome to Global Power Hour. Thank you for joining today. My name is Dr. Keith Pettiford, and I'm going to be walking through risk management, and I hope that you enjoy this presentation. So before I get started, I definitely want to thank the World Trade Center Delaware, Dr. Murray Swinson, Brian Nesrin, and the entire team for this opportunity. I really am excited to share a risk framework that has helped small and mid-sized banks and businesses close a critical gap managing real-world risk without enterprise level budgets. And by that, I mean a lot of large organizations have these large risk management departments. And these departments can focus on risk at a product level, at a type of risk level, a lot of different ways that they can do it. And they're pretty robust departments. But a lot of small and mid-sized businesses do not have these resources, these level of resources. And so I want to walk you through an actual framework that's going to help close some critical gaps within your business, really helping you manage real world risk without these types of resources available. And so I'm going to walk through a bridge framework that we created, a practical operating system that's developed to build resilience in your business or organization. Well, before we dive into the actual frameworks and strategy, I want to start with a story because this is the best way to understand risk. It isn't through a policy manual or anything like that. It's about what happens when risk goes unmanaged. So here's a true to life scenario that played out in a community bank I reviewed. And again, small and mid-sized banks can utilize this, small and mid-sized businesses can use it, whether you're profit or nonprofit. We all experience very similar processes and challenges, and much more than people would want to admit. And so I really want to walk through this specific example called the auto loan that almost broke the bank. And I want you to picture a community bank that's really eager to grow, really to expand its offering. And so they launch a low rate auto loan product. Dealers love it. The customers come in, they take advantage of it. They start to see some good performance. Leadership starts to celebrate. But then 6 months later, we start to see first payment default spike. We start to see delinquencies climb. And this could impact net charge-offs and then ultimately impact profitability, right? And then all of a sudden you start to see regulators or auditors come in and start asking the hard questions that now you have to answer, right? And it's not that the product was flawed. The failure was really in the risk oversight. There was no stress testing that was done on the rate and term combinations. The dealer oversight was weak. There were some challenges with the vendor and how they evaluated the scoring model, and there was no monitoring in place. And again, from an early warning signal perspective, they weren't in place. They were completely absent, right? And now contrast that with a bank that actually put in some simple habits to really make sure that they control for some of these risks, like putting in a one-page risk appetite statement to really understand what thresholds you want to be able to manage to, you know, putting in the proper due diligence pre and post the actual launch, and putting some of these tools in place to, again, be more proactive. Having 10-minute, weekly huddles to review some of the performance, to review some of the trends, to look at any customer feedback, dealer input, all these different things, and really make sure that things are moving accordingly. And again, getting ahead of things before they actually happen. Uh, those small disciplines make all the difference. And the lesson is really that big risks, again, don't live in just big companies, right? They hide in all organizations, small, large, profit, and nonprofit, those organizations that make everyday decisions. And so the goal really is to embed risk thinking from the start, right? Turn it from a silent threat into a more of a strategic advantage. And so what's the real problem? Why do so many small and mid-sized institutions run into these situations? And it's a risk gap, right? Something that we really need to understand clearly as we move forward, to understand what are some of the challenges, what are some of the gaps, what are some of the issues, and finding ways to close that. And again, be more proactive. So here's just some of the things that are challenging a lot of the different organizations, and the list is endless, but I want to just kind of touch on a few. Because sometimes small and mid-sized organizations operate in an environment of complexity. There could be credit issues, there could be fraud issues, there could be dependencies on vendors, and you may have some problems with those third-party vendors. There could be cyber threats, environmental threats, technology, especially in the world of AI that we live in today, economic challenges, and many organizations, especially over the last several decades, have experienced issues with the fluctuating economy and the impact on customers, which also can affect consumer preferences and actions and behaviors, as well as regulatory expectations, right? All of these things can compound at once. And like I said, unlike large institutions that have dedicated risk teams to cover some of these specific challenges, some of the smaller organizations have limited resources, limited headcount, constrained budgets, and processes that may be fragmented. And so the risk gap can widen even more when you bring in the governance aspect and compliance and operations, and especially if each of these things work independently and not in sync, right? Again, I mentioned technology and how that can accelerate the problem, as well as, again, any other vulnerabilities that may take place from a day-to-day perspective. And these things can move faster than any type of policy or process can keep up if you don't have, again, that proper risk management lens over top. And so the critical insight here is really that resilience doesn't really require massive resources. It just requires clarity, establishing a risk culture within your business at all different levels, and then also having a specific cadence to ensure that, again, you have everything in place to help you mitigate a lot of these risks and prevent a lot of these risks from occurring. Doesn't mean that you have to have, all these policy binders, because they don't really protect you, right? It's really principle-based appetites, actionable indicators, and accountability. Those are the types of things that's really going to help your business or your organization. And if you look at the last bullet on the page, I actually noted and researched 72 and then some potential risks to businesses and organizations, and the list continues to grow. And I say and then some because there's other ones that are starting to emerge as I dig a little bit deeper. But there are clearly a lot of different risks that your business could be exposed to today and you may not even be aware of. And that's where, again, this type of framework can really add value. And again, how do we close the risk gap? It's the bridge framework. And this framework was really built to help manage some of these gaps, right? And it's not just a compliance exercise. It's a practical operating system, right? It has 6 pillars that work together to make risk management more of a daily habit rather than an annual occurrence, especially from an audit perspective. And I'll talk a lot more about that in later slides, but let me just kind of walk you through the bridge framework. And so I'm going to walk through each one at a high level, starting with B, which is baseline risks, and KRIs, or key risk indicators. This is where you help identify, your top 10 enterprise risks and pairing them with 1 or 2 key risk indicators. And this will help give you early warning signals. So understanding what these key risk indicators are, and then you have that in your reporting. And again, these things can potentially give you early warning signals that something may be coming. R is risk appetite. And this is where you translate those risks into like a 1-page executive team or leadership team or board approved statement that, again, makes sure that everyone is on the same page and they're clear in terms of their limits, triggers, benchmarks, etc. I is integrate controls. And this is where you embed risk ownership, again, at every level, directly into the frontline process, right? It's not just with the risk team. Accountability is for everyone, and all of these controls are integrated throughout. D is the dashboards, reporting, just a concise set of reports that allow you to review these key risk indicators, key performance indicators, and there's a variety of different ways that you can build a lot of these reports. You can use traffic light thresholds at red, yellow, and green. You can use trending arrows up, down, or flat if performance is flat. a lot of different ways that you can visualize some of the performance so that leadership sees what is actually happening and what matters at a glance. Okay. And so again, just another key step in the process. G is for governance, lean policies and procedures and processes that are documented. Whether again, how you evaluate vendors, how you make changes, how you evaluate some of your existing processes. What's the process in terms of making updates and how often do you make updates? Are there specific playbooks that walk you through different scenarios and who handles what and when and how you handle these things with a bureaucratic oversight and those without bureaucratic oversight that you can move fairly flexible in a very flexible manner without again a lot of that resistance when you need to move a little bit quicker to resolve an issue. Okay, and then there's E, which is execute cadence, and that's specifically again how you execute and executing with effectiveness and efficiency, right? And I even like to quote like a 10-10-10 model where again, you have a 10-minute huddle every week, again, where you're walking through a lot of components, you're getting feedback from different areas or departments, you're getting feedback from customers, getting feedback from third parties, you're evaluating performance, you're looking at these risk indicators and having some key discussions, reviewing these 10 key risk indicators, and then having specific actions that align with these key risk indicators so then that way you can take these specific actions if you start to see the needle move in one of these different risks or metrics, right? And so together, these pillars really transform risk management from more, again, of a compliance toolbox or a checklist into more of a development and a growth mindset to really allow your business to grow and flourish without a lot of resistance. And as you can see from this image I created, that again, you see the water, it's the risks that are sitting out there. And with these risks, again, this bridge framework kind of sits above it, helps prevent things from falling. Even if you have limited resources, again, you'll still be able to use this tool effectively and really bring forth some really positive outcomes. And so now what I want to do is I want to go a little bit deeper into some of the aspects of that model. And I want to start with baseline risk and key risk indicators. And again, this is a starting point for any resilience operating system, knowing what you're exactly managing. And this means identifying your top 10, again, risks that are out there, things like whether it's credit concentration, delinquency performance, retail challenges, inventory, fraud exposure, vendor failures, cyber incidents, product management, the list goes on and on. And again, it just depends on your business or industry because every organization across these different industries are going to be different. So this gives you a chance to dig a little bit deeper into your organization to really understand what are these risks. And for each risk, you assign one or two key risk indicators. They're not the outcomes. There's just, again, things that you manage to. Those are the early signals. Think of them as a check engine light, right? You have a check engine light on your car. And, when you see that check engine light, you don't know what the issue is. So you take it, have a mechanic take a look at it, diagnose it, because again, when it comes to a check engine light, it could be a number of different parts of the vehicle that could be impacted. Once they do the diagnosis and pinpoint the actual issue, then they'll be able to, discuss what's the actual process to fix that specific issue. And again, this acts very, very similar. Okay. Whether you're looking at a delinquency trend, sales performance, increase or decrease, especially decrease, poor customer scores, customer interactions, whatever it is, again, these types of things will allow you to look at these metrics. They'll tell you if something is shifting before it becomes a crisis. And really the discipline here is just specificity. You want to be detailed as possible, make sure everyone is on the same page in terms of these are the different metrics that we want to be able to review and evaluate. We don't want to be too vague. We want to be specific so that we can truly drive actions if things occur. Okay. And so again, we want to make sure that we look at these indicators. One of the other key components is risk appetite. And this is where many organizations unfortunately skip a step or have not fully evaluated this step, because again, you can produce as many quality documents as you want. Sometimes people read it, sometimes people don't. You want to have certain disciplines, but the risk appetite statement really should fit on one page. It should be, a simple question that gets answered so that, again, everyone is seeing things the same way. And the simple question is really, how much risk are we willing to accept in pursuit of our goal? Again, how much risk are we willing to accept in pursuit of our goals? For banks, it might look like, making sure that auto loan delinquency does not exceed 2.5% of the portfolio, right? Or fraud losses, we don't want them to exceed X amount of dollars per quarter. For businesses, it may be, we don't want to carry more than 60 days of inventory risk without some sort of mitigation plan. For a nonprofit, it might be fundraising thresholds. For an academic institution, it may be, if we don't make a certain number of, we don't have a certain number of students that we enroll or are accepted or whatever the case may be, right? And so these limits can become more of decision-making guardrails. So when you institute a new product, service, program, and you really want to evaluate these things, this risk appetite really gives you that opportunity to give some benchmarks and, again, look at those guardrails and those thresholds. And it gives your leadership team and those decision makers something really concrete to agree upon and then build upon. And that accountability will start at the top, and then that accountability should flow throughout the rest of your organization. And so what I really want to do now is make this even more real by walking through some specific stories and kind of show some of the quick wins that have occurred in my estimation when I reviewed some specific organizations. And again, this bridge framework does not only work in theory, but in real world applications. And that's why discipline matters in terms of instituting this type of risk oversight on your business. And so I'm going to share a few quick examples that kind of illustrate what happens when businesses really apply some of these risk disciplines. And so first, I'll give you an example of a bank, just kind of bridging off of that original example I gave you, where, this one bank actually decided to stress test a loan, before it actually launched, right? So they ran some stress tests and they found some, unique results from the stress test in terms of, increases in certain metrics and, a drop in potential values and these types of things, especially from a pricing perspective, and how they saw that this could potentially push defaults above certain tolerance levels. And so they recalibrated their pricing, tightened some of their, strategies, had some more training and conversations with dealers, and this helped them avoid a loss spiral, right? And this was very, very good for their business. Another example is a model drift detection, where a company was using, again, a third party and using their model to really help build, some really robust strategies. And then they had some key risk indicator monitoring as a part of its oversight. And by having that oversight, they saw where there was some problems with the model and how it predicted and how it didn't provide the effectiveness that it was expected. And they were able to catch it early. They were able to retrain some things, review some of the data, and then make some adjustments to avoid further things down the path. So again, just another way to actually, provide some value there. And then there was an example of a retail business reviewed where they were facing some cash flow risk, right? They were having some declining sales. They had rising inventory costs, and, they were really strangling to, pay suppliers. Their ability to pay suppliers started to really diminish. And so they created a simple dashboard where they had some tracking. They tracked days payable, outstanding. They tracked inventory turnover. And this really gave leadership a signal that they needed to act before missing payments. And then another example is a nonprofit that they had an audit risk situation where they had weak controls over donation tracking. They allowed funds to be misclassified. They created compliance exposure issues. And again, they were able to have internal controls and looked at this and caught it before the audit actually occurred, right? And so by having a monthly reconciliation process, and some other controls, they were able to close the gap again well before the audit. Because with many companies, unfortunately, they'll wait until an audit is actually announced, and then all of a sudden now they're scrambling and trying to get things together to really make sure that they're ready and prepared for the audit. Where if you do a lot of these things all the time, when they actually are, announce an audit, you already have most of it ready to go. You just have to package it, give them exactly what they're asking for, and now you're ready for the audit and really looking forward to that, satisfactory rating without, any recommendations, which is always the goal when it comes to an audit. Okay, and so the common thread with all of these different, examples is that with, small habits applied consistently, you can truly prevent crisis and again be more proactive than reactive. And so we covered the structural side of risk management, but one of the things that often gets overlooked is risk psychology and leadership, right? The psychological aspect of it, the thought leadership process, because even with the best frameworks, they can fail because, the people involved or the people running these processes aren't exhibiting the right skills and tools from a psychology and leadership perspective. And risk is a deeply human activity, even though you have a lot of automated and tools and algorithms and things that you can use to evaluate things a little bit faster, models that you can create in Excel, whatever the case may be. All of these different things are great, but human beings have to be a part of the process, and they come with a cognitive biases that kind of distort how we perceive and respond to risk. And so I want to talk about that a bit. And so three biases show up most often in risk decisions. First, there's loss aversion, where most people will work harder to avoid a $100 loss than to pursue a $150 gain. And this is where framing, especially framing the problem, really comes into play. Whenever I teach students in my risk management executive decision-making class, I speak to this quite a bit in terms of framing the problem and how to do it and communicate it effectively so that everyone is on the same page. The same with how you frame the outcome and the result and the why behind it, right? Those things are critical as a part of the process. And when it comes to avoiding loss, sometimes people frame it very, very differently, right? And in risk management, this shows up as a reluctance to escalate bad news or acknowledge that a product isn't performing. There's a number of different ways that it can show up. And so again, it's just something to be mindful and aware of. There's optimism bias, where we consistently overestimate how well things go. Leaders launch products assuming best case outcomes without the stress testing, and that can become a downside. And I kind of spoke to stress testing a little bit earlier and its advantages. Some people, especially if they want to overlay economic components, they may look at Moody's and the different scenarios. So again, they can be able to move things a little bit more. Some people use, from a statistical standpoint, standard deviations and see how those levels will move. So again, a number of different tools at your disposal, but stress testing is also a very good tool to use. Then there's availability bias, where we kind of overweight risk that we've seen recently and we underweight risk that we haven't experienced, right? If your business has never had a cyber incident, it can feel like an abstraction. You've never seen it before. So now how you view it and how you approach it could be very different than someone who's seen it and had it before and how they react. Even take COVID, for example, where there were a lot of companies that, and take restaurants, for example, that were able to adjust and move things around a little bit and make the appropriate adjustments for their business, as opposed to others that really weren't prepared and unfortunately weren't able to navigate, this dynamic that impacted, the entire country and, entire world for that matter. And here we are now. You run, the risk of potentially losing your business. So again, being really mindful from that perspective. And so building risk literacy means really understanding these behavioral patterns and designing processes that can help you work around them. And that includes also having tough conversations and building bias check questions into your meeting. Asking certain questions like, are we assuming the best case? What are we not seeing? Who has a dissenting or different view? Bringing those types of conversations into, the forefront, again, gives you a lot more information and knowledge that you can be able to churn through. And this, again, that thought leadership, being open to challenging and exhibiting, those types of actions and behaviors can really add value. And that type of culture can be rewarding. And, as you question assumptions and dig a little bit deeper and bring a lot more diversity of thought into the room, it can help you make you also more resilient. And so we've covered the framework. We covered a lot of the, again, structural components of it, talked about the psychology and the leadership aspect. And now kind of like, where do you start? And so really the answer is really a structured plan that kind of installs some just foundational habits, identifies gaps, and again, does not overwhelm your team because again, you may not have enough resources to dig too deep, but you still want to have that risk management oversight. So you want to be able to, institute a framework that can be able to help you through that. And so here's a couple of action plans that can definitely add value. And again, these are high level, but again, they can help you within your business or organization. And so you can map the top 10 risks and select your key risk indicators, as I mentioned. And again, overlay that with your risk appetite statement so you kind of know where your benchmarks, your thresholds, your guardrails are. And again, a lot of these things right out the gate don't have to be perfect, but again, you want to have them and start to develop them. And over time, you'll start to see them really crystallize into things that that you can move forward with and always take the time to go back and review them. But, you don't have to wait for it to be perfect. Keep those working drafts, review them with your peers, review them with leadership. And again, a very valuable tool. You can, again, continue to launch or start to launch, your 10-minute weekly huddles, again, walking through data, walking through information, walking through, new insights from different areas, looking at performance, looking if there's any blips on the radar. All those different things can help as well. Even from a pre-launch or pre-implementation perspective, having specific checklists and guidelines. So then that way, again, you understand where the potential risk could be. And then post the launch, you can, again, have the appropriate tracking and monitoring in place, the early warning signals for any new product or initiative that's in flight. Again, if you have third parties or you're working with other departments or areas or companies, making sure you do the proper due diligence there because not every third party or vendor carry the same risk, right? You may work with one company for, the last 2 or 3 years, or, that they have a specific reason for working with them. You then want to move to someone else. And then all of a sudden, they give you something a little bit different, but the risks associated with each company could be very different. So again, you want to be able to, review, assess them, not only before you engage, but also after the fact. Any type of processes that you have, make sure they're clearly documented. Make sure you have, key playbooks that everyone is aware of, especially if you have people, who, you have multiple people in your department, making sure that they all know what's in that actual playbook. You don't want a single point of failure. Again, these are just little nuances that could be able to help your business as you review, your details, all of your processes, your entire business from top to bottom, and really put some controls in place to really help you manage your risk. And this high-level plan is really just to create these habits that compound and really, again, continue to help you foster that risk management mindset. And that consistent execution will help you build more resilience over time. And again, something that I highly recommend. And so we covered a lot of ground today. So I want to bring it together with really a clear call to action, some really good things that can actually, again, help you bring all of this together and then take this back and really, install some really good components that's going to really help you manage risk, have that risk culture within your business, and it'll add a lot of value. It'll save you money. It'll provide efficiencies. It'll again, foster another new view of your business that, again, allows you to surprise and delight customers. It has a lot of good benefits that'll be able to provide you with, and it'll leave you with some really good intentions as well as some key next steps. And as you can see on the top of the page, risk management is not a task, it's a mindset. Okay, it's really about just having that risk management mindset across your business and across your organization. Okay, because resilience isn't just a budget line item, it's actually a habit. And you want to exhibit these types of habits. And these habits are really built through simple and repeatable practices that are embedded in daily operations. And again, over time, you start to see the value. And there are many tools that you can use to help manage risk effectively, but the bridge framework, again, is a practice. It's not just theory, it's actually been put into practice where, through risk governance design, whether it's decisioning strategies, policies, and procedures, whether or not you're looking to modernize, if you're trying to create new and innovative dashboards and reports, if you're really trying to fully evaluate some of your marketing programs, your sales programs, the launches of new products or services, all of these different things can be enhanced by using the bridge framework. And this was basically put together by my company, KRP Strategies, and really takes this approach and has actually utilized it and made a lot of companies better. And so, as you can see at the bottom, I have a free risk readiness assessment as well as a QR code. So you can use the link or the QR code. And this just allows you to take that risk readiness assessment, again, assess some of those risks, use this as a starting point to kind of, outline where you are today and identify some of your highest priority gaps. And again, use that, really assess it, and then that'll allow you to start small. And then with further conversations and discussions, we can really figure out, based on some of these different challenges that you're having, what are some tools and steps that you can use to put in place to help mitigate these risks, to help control for these risks, to help remediate if you do need to remediate, because that has happened on occasion where we've identified some things that unfortunately had caused some issues that they didn't realize were an issue. So they had to kind of go back and remediate. But again, at the end of the day, this tool will really be able to help you, again, identify the gaps, use this immediately, and be able to, again, use some of the tools that'll really help you get the traction that you need to really have that risk management mindset. Okay, so thank you again for your time and attention. I believe every leader and organization that is in this room, that's outside of this room, regardless of size, they have the capacity to really build genuine, effective, and efficient risk management practices, really build that resilience, and the bridge framework is your blueprint. So again, I really hope that you take advantage of this. It'll really add some great value. If you have any questions, you can always reach out to me. I definitely want to thank you for your time and attention today, and have a great day.